welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, January 25th, 2021, and I'm pre-recording this Trading Places Live for Tuesday, January 26th. Futures are slightly lower this evening after a pretty wild ride on Monday. Going to get into that in just a minute. In today's agenda, we'll go through that daily market recap. Then I'm going to go into talking technically. I'm going to show you a little bit about a couple of things I would look for in terms of a potential market top somewhere down the road. I don't believe we're anywhere near one. And I'm talking about a significant top. I'm not talking about, just before a slight correction. I'm talking about something that could lead to, a 20% drop or more, something along those lines. So I'll get into that during talking technically. Then we're going to go through moving averages. I want to show you a little bit how I use moving averages, and especially on pullbacks when we've seen a hot group or a hot stock move to the upside and then pull back. I'll show you a little bit about that. Then I'm going to get into the earnings spotlight. We are starting to see earnings pick up. Earnings season now kind of cranking into gear. We've got some really big reports coming out later this week, so things are slowly picking up, but that will change and will begin to accelerate pretty rapidly into earnings season as we move throughout this week and next. And then we'll wrap up with the three you must see. I got three breakouts for you that I thought were all pretty significant on Monday, so we'll end the show with that. Before we get into any of that, I want to take you over to earningsbeats.com. Make sure you sign up for our free Earnings Beats Digest newsletter if you haven't already. Simply type in your name and email address, hit that subscribe button. We'll make sure you get added to our list. I do publish an article there Mondays, Wednesdays, and Friday mornings. They typically are out before the market opens, dealing with relative strength, earnings, sometimes giving some pretty good trading opportunities. Occasionally it's a short squeeze, could be a prediction on an earnings report coming up. I think you'll enjoy it. I think it could add to your trading knowledge and your arsenal. So sign up for that. If you'd like to check out our service, hit this Join Today button. And I would love to have you try out our service. You can check out our performance of our portfolios. We do a lot of research. I consider us to be more of a research and education platform for a lot of folks. And a lot of our information, if you're also a StockCharts member, you can download our research right into your StockCharts account using chart lists. So I think it's a pretty awesome service. You can try it out for 30 days. There's a $7 trial, but we'll refund that $7 to you within a week. So essentially, it's a no-cost trial. Love to have you try it. All right, let's move on to the market. What happened in terms of the recap here? Oh, it was a pretty crazy day. I mean, we had the market pretty solid at the open, especially on the NASDAQ. And then in the first hour to an hour and a half, things really started to sell off. We lost a lot of ground on a lot of stocks, especially in technology, consumer discretionary. Many of the short squeeze stocks, some of the highly shorted stocks that we've seen have some really big runs to the upside, continued that in the first 30 to 60 minutes on Monday and then reversed hard. A lot of them, a stock like GameStop, which ran from about $65 up to almost $160 in the first hour, and then literally turned around and went negative within a couple hours. I mean, it was just absolutely stunning volatility on some of those stocks that are heavily shorted. But overall, if you look at the major indices here, you can see the Dow Jones Industrial Average, which did tick down below its 20-day EMA during the day, closed comfortably above that level, closing at 30,960. That was down 37 points on the day. You can see the 20-day EMA is at 37.85. So we finished almost a couple hundred points back up above that 20-day, even though intraday we went down below it. So like I said, it was a pretty volatile day. The S&P 500 finished up 14 after nearly testing its 20-day EMA. NASDAQ up 92. So on a relative basis, this was your winner on Monday. The NASDAQ performed very well. Mid-caps, small caps, mid-caps, small loss, small caps, small gain. All of these indices, though, as you can see, continued to trade and close above their rising 20-day EMAs, which also are above their 50 days. So really good configuration there. If you go down and look at the AD lines, accumulation distribution, all of them pointing higher, I think supporting this move to the upside. As far as our sectors go, Utilities and staples, two defensive groups, led the action. Short term, that's not great, but we didn't break out. I mean, for the most part, we were just simply sideways consolidating recent gains. The NASDAQ was really the only area to break out. What we don't want to see is continuing breakouts to the upside with continuing leadership from defensive areas. Day here or there, no big deal. But over a longer period of time, I'd be a little bit more cautious. Energy was the weakest group, losing more than 1%, testing that 20-day moving average, though, and also the recent price high that we saw in December. So this could actually be an area ready to rebound off of that 20-day moving average. We'll want to kind of watch that on Tuesday. Autos had a really strong day, up almost 3% on Monday, moving up to that 1,078 level, getting very close to 1,100 for the first time in history, trying to close above it. Not so good, though, on Monday was the non-ferrous metals group. This is where we get Freeport-McMoRan. That stock did struggle on Monday and led to a 5% drop in this index. The other thing I would say, though, is as you look across these AD lines, most of these AD lines pointing higher. I would say the only one that's really been weak was utilities, and even that one is starting to turn back up here in January. So pretty good action there. The 10-year Treasury yield, as you take a look at this, we were down about 5 basis points on Monday, so money rotating into Treasuries. That kind of fits that same theme, seeing the defensive sectors leading in the stock market, also seeing money rotate towards Treasuries. So definitely the market was being a little cautious on Monday. As far as economic reports due out on Tuesday, we've got the November Case-Shiller Home Price Index due out in the morning, expected to rise 0.8%, which is down from October, which was a rise of 1.6%. And then the November FHFA House Price Index expected to rise 1%. That'll be out in the morning as well. October's rise was 1.5%. So we are seeing or expecting to see a little bit of a slowdown in that housing area. And then January consumer confidence is due out in the morning as well. 88.5 is the expected reading. December was 88.6. So a very slight downtick there. Do want to also mention that the Fed meets tomorrow, Tuesday, Wednesday, 2-day meeting. So they'll be out on Wednesday with their announcement. Don't expect any change in interest rates, but their language obviously is always something that we want to listen to, as it will potentially impact the market. I can't imagine the Fed coming out with anything other than news to help the market. That's been their just kind of what they've been doing for the past several months. I mean, throughout this pandemic, they're trying to support the market in any way they can. And given the initial jobless claims, which remain high and so forth, I would expect that the Fed is going to essentially say, hey, we're here to help out in any way we can. We're going to continue to watch inflation. But unless there's a big spike in inflation, I would not expect the Fed to raise rates anytime soon. They're on record saying that they wouldn't expect rates to rise until 2023. And if that is correct, 2 more years of historically low interest rates with demand picking up coming out of a pandemic, I think could set up for a complete melt up in the U.S. stock market. So I continue to stick with that line of thinking. I think that's all I had here for the 10-year Treasury yield. So let's move on to talking technically. So in talking technically, this is a 25-year chart of the S&P 500. And what I wanted to do is just pull up a, not the right, let's get rid of that. So the first thing I just want you to understand is that a secular bull market is a long-term bull market. Okay, secular bear market is a long-term bear market. When we topped in 2000 right here, and I'm going to go ahead and pull up a rectangle here, starting in 2000, right about this level. I mean, this is the secular bear market that we were in for 13 years. So a secular bear market doesn't end until you break out above these tops. So the double top from 2000 and again in 2007 was cleared in April of 2013. That is when we had confirmation that the low in 2009 began a bull market. We didn't know that until we get the breakout, because we could have just come up here and rolled over and gone down again. So, but you can see 13 years we went nowhere. A lot of folks are looking back and saying, well, this is where we are now and this is where we were in March, can't go any higher. I completely disagree with that line of thinking. First of all, we were on our way in February of 2020. We were up at 3,400 at that point before the pandemic hit. You can see we're in a nice channel. This is what you get into in a secular bull market. So this move to the downside, in my opinion, I stated it at the time, I continue to state it, it was simply a cyclical bear market. It was not a secular bear market. It was cyclical, short-term in nature. 3 months, well, actually it was in about 4 weeks, but a few months later, we were essentially right back at the highs or close to it. I mean, the S&P 500 was only in this move to the downside for 4 weeks. Since then, we've been resuming that secular bull market that we had. You look back to the trade war in 2018 and 2019, we had some big hits. They were corrections. They were all within a secular bull market. We continue to trend higher, and I believe we are going to continue to trend higher. Are we going to pull back from time to time? Of course we are. But you have to remember, we go in cycles with these big long-term cycles. And for 13 years, it's unreasonable to think that the value of the US companies from 2000 to 2013 were flat. GDP grew. The stock market just didn't keep up. And so what happens is you move into a secular bull market, you play catch up. And this catch up tends to take up to a couple of decades, 1980s and 1990s. You don't see it here on this chart because it started at 1996. But for 20 years, we moved up, sideways consolidated for 13. I think we're in the process of moving up now for another 20. I think this is going to take us into the early 2030s with some pullbacks and some corrections along the way. So anyhow, looking at this, I believe we were in this secular bear market. We broke out, and now we're in a secular bull market. So you got to kind of keep that in mind as we go through a couple of other charts. So I'm going to start next with one of my favorite intermarket relationships. And actually, I'll say it's my favorite, the XLY versus the XLP. Consumer discretionary versus consumer staple stocks. Follow this ratio. This is really an important ratio. And I'll show you how it works here on this chart. So at the top here is the ratio XLY versus XLP. And you can see since 2008, we've been moving up. Since early 2009, the S&P 500 has been moving up. We're confirming. In the bear market, the XLY XLP was moving down, just like the S&P 500. During 2002 to 2007, we were mostly moving higher, along with the S&P 500. So if you look back over the last 20 years, look at the correlation between the direction of consumer discretionary versus consumer staples and the direction of the S&P 500. And you'll see that that correlation is almost always positive, many times above the 0.5 or even above the 0.75 level, telling us that there's extremely strong positive correlation between the direction of this ratio and the direction of the S&P 500. And it just makes sense. Consumer discretionary companies sell us the things we want. They're going to do well when the economy is strong, when we feel good about our financial situation, when we're willing to spend that money on discretionary items. When the XLP outperforms, it's telling us that we're not willing to spend that money on those discretionary items. They're not performing well. And as a result, we normally are seeing a weak stock market. Now, I want to point out back in 2007, where the stock market topped. So I'm going to draw a vertical dotted line in 2007, right here in October. Oops. Right here in October 2007. That's where we topped. That's the S&P 500 top. I want you to take a look at what was going on in this ratio before the top. I mean, we were, already downtrending, really. Let's put this in red. But I mean, you can kind of see that we had this channel already moving down 2005, 2006, 2007. And by the time the market topped in October, look at where this ratio was. Look, in probably in late October, early November, we were breaking down to about a 4-year low when the S&P 500 was up near a high. All right, you ready for this? Watch the bottom. So on the very bottom, actually, I'm going to put this in red because that's kind of a warning sign. And now I'm going to put in green the market bottom, which was right here in March of 2009. Now, at the top on the S&P 500, you can see this ratio was weakening. And at the bottom, I want you to take a look at what was happening. The S&P was setting a new low. This ratio did not. Money actually started rotating towards consumer discretionary. That was a hint. Why would we be going lower? Why would the market be thinking about moving lower and money rotating into discretionary items? Wouldn't make any sense. This was actually a positive divergence that I think was certainly worth paying very close attention to. Now, when we look at the action that we've seen in the XLY, XLP throughout this bull market, I mean, we've been going higher and the market's been going higher. I think probably for me, the only really what I would say was bearish signal, and when I actually turned a little bit bearish, was back in January of 2016. And that is when we saw that right there, because we were breaking down below these lows. See this top, we break out, we test it, then we break to a new high. And then as we were rolling over on the S&P, it looked like we were breaking down, and that ratio went, turned lower, broke down as well. That worried me, but we came right back. The market came back, and so did this ratio, eventually moving to new highs. Now, we got hit we were already weakening going into 2020 in this ratio, and then the pandemic hit. And so, of course, we took the big hit, but we held the prior lows. And now look at where we are. I mean, we're soaring in this ratio. Money is rotating heavily towards consumer discretionary. Why would we be doing that if there was going to be a top, if there was some kind of significant top coming? Just doesn't make any sense. So I'm still in the camp based on not only this chart, but I'll show you another one. Now, this is the big one for me, though, because you can't really argue with that correlation. That is just tremendous positive correlation. So when I see the ratio supporting the S&P 500, it's hard for me to think anything other than bullish thoughts. Next up, I'm going to show you the transports and utilities, though. So transports, utilities, now you come down here, it's not quite as strong, but we spend most of our time in positive territory. And I think the correlation's been even stronger since we've been in this bull market. But if you look back in 2007 when the market topped, this ratio was down, fairly close to a 5-year low, much closer to a 5-year low than to a 5-year high. So that means utilities were outperforming transports at the high. Makes no sense. That's where you want to be careful. Now, at the very low, the ratio wasn't giving us any kind of positive divergence, not like the XLY, XLP. But when we started turning higher, here we go, moving higher. Once again, during the pandemic, we came down, we took out this prior low. And you can see this also took out this prior low. But since then, and now that we're moving up, look at this ratio. Transports completely outperforming utilities. Now, if this ratio was still down here somewhere near a low, then you'd have to question this move, at least in part, because transportation stocks, I mean, if the S&P 500 is going higher, it should indicate that profits are going to pick up, the economy strengthening. Well, in that case, more goods should be shipping. And if more goods are shipping, transport should be doing well, and they should be doing better than utilities, which are defensive. And that's what we're seeing right now. So this is another sign that I think supports the stock market going higher. Now, one last thing I'll talk about here, and that is the XLF financials versus the S&P 500. And I want to take you back to this high again back in 2007, because we all know that the bear market 2007 to 2009 was a financial disaster. And if we pull up the same chart here, I'm going to do that as of October 2007. I want you to take a look at what was going on in financials as we were near the top. I mean, that, maybe we could go up here. You can see a little bit of a breakdown there. I mean, in the summer of 2007, the XLF relative to the S&P 500 had moved to a 4 or 5 year low right here. That isn't a good sign in what's supposed to be a bull market. And when we finally started to turn down a little bit here off the top in the fourth quarter 2007, financials were falling apart. Everybody thinks that 2008, we had the Lehman Brothers fiasco, Bear Stearns, all of that. I think that's what most people think about when they look back on this period. But you need to realize that things don't just happen one day. It's a process that builds. And if you were following relative strength, the financial group was getting hammered long before we saw the final fallout in the financial services area and in the banks in particular. So that's why I continue to follow what I follow. Now, financials have had a rough go of it. I'll be the first to admit. Coming off of this low, we started to strengthen. We've pulled back. Now we're strengthening a little bit. Financials have not been where the strength has been. It's been mostly in technology, consumer discretionary, communication services, and maybe a little bit more in industrials. But financials have kind of been the laggard. So this continues to be a little weak, although since the vaccine news, you can see financials are starting to make this push back to the upside, which is good. And this relative PPO has gone positive, which and it's the most positive it's been probably in the last almost 3 years. So we've got some positives developing here on the financial side. And this is really the weakest link of the aggressive areas of the market. So that's one of the reasons why I remain so bullish the market. All right, let's keep moving on. I want to talk a little bit about moving averages. And before I do that, I want to just show you, this is the financial sector over the last week. These are the various groups. Now, looking at the scooter, which is the StockCharts technical rank, it tells us that investment services and banks are the highest have the highest scooter scores. So they are, in essence, the best relative performers over the last few months. And in the last week, as this group, as financials have pulled back, these two, because they've done so well, had more profit taking, which kind of makes sense. But let's take a look at the banks first on their chart. And I want you to see this move up here in early January and the continuing push. This was all heading into earnings. So banks were really moving up into earnings. Once the earnings started coming in, we're seeing a sell on the news. But I really like that reversing candle that we saw right on the 20-day today. That 20-day moving average, when we've got some pretty good momentum going and we pull back, I look for that 20-day moving average to hold as support. I mean, you can see it a little bit back in mid-December, when we went sideways, held the 20 and then broke to new highs. Here we're pulling back, testing the 20, testing gap support. I expect we're going to see a move back to the upside in the banks. And specifically, what I would be looking for maybe is something like JP Morgan, which printed a nice reversing candle right on its 20-day moving average, and then PNC, which also came down just a little bit below its 20-day, but right in this gap support zone, and also printed a nice doji, long-legged doji, reversing candle. The thing I really like about PNC too is that AD line continues to move higher, even though prices have pulled back. I think that this pullback is being accumulated by Wall Street, and therefore, I think you're going to see PNC moving back up and breaking out again. Also on the chart, if I can go back here, investment services, I wanted to bring that one up because that was the other one that had a rough week. But look at investment services also over the last couple of weeks. We had Morgan Stanley report earnings. We had Goldman Sachs report earnings. Since then, we've seen selling in this group. Buy on rumor, sell on news. So let's take a look at some of these stocks. I'm going to start off with Goldman Sachs. And Goldman Sachs, there's your move up. Earnings come out. Here's your move back down. But look at the AD line, strengthening. Look at the relative strength, Goldman Sachs relative to its peers. when it set its high a week and a half ago, it also set a relative high, 52-week. I think Goldman Sachs looks good on this pullback, along with Morgan Stanley. Same type of thing. Move up, nice relative strength, setting new 52-week highs, pulling back, hitting that 20-day. I expect to move off of it. The last one I'd point out here is Schwab. Charles Schwab also pulling back, hitting its 20-day moving average after setting 52-week highs relative to its peers. Also relative to the S&P 500, and ultimately, that's the index that we want to outperform. So I think all of these stocks I mentioned in the financials, now that we've had the pullback, I think your reward to risk looks pretty good on the long side. Couple of earnings reports. They are starting to pick up. So let me just pull up a couple of these. I'm going to go with some that reported after hours tonight that actually I think look pretty good on their charts. So GGG, which is Graco, this is in the industrial machinery. Stock's been going up consistently since the March low. Also, look at the AD line going right up with it, which is awesome. Relative strength, GGG versus its peers at about a 9-10 month high. Relative to the S&P 500, just set a 52-week high. Stock came out after hours this evening, 61 cents versus 51 cents, and the stock was up about 3% after hours. So GGG getting a nice reaction to a solid report, and I think technically looks pretty good. STLD, I was expecting a little bit more out of the stock. They did beat, they came in 97 cents versus 86 cents. Stock's up about 1.5% after hours, but you can see another stock that's been trending higher. Steel's been going higher. Steel Dynamics relative to its steel peers has been going up, and it's also just hit a 52-week relative high. So it's gotten a decent reaction, up about 1.5%, but it doesn't appear like it's going to break out unless things strengthen in the morning. Last one I'll point out here is Crane, which reported after the bell. Now, this one was coming off of a 52-week relative low versus the industrial machinery group, but it had been strengthening the last 3 months. AD had strengthened. Stock had pulled back a little bit going into earnings. They actually came up short on their earnings, $1 versus $1.09. Stock's down 2% after hours. So we'll see how it opens tomorrow. I'd really like to see this hold its recent low in that 50-day moving average. So this one will be one to keep an eye on. But earnings will be picking up tomorrow and throughout the week. Tomorrow morning, we got Johnson & Johnson coming out, 3M. American Express will be one to watch. IVZ, which is probably one of the stronger stocks going into earnings tomorrow. Really nice chart on IVZ. You might want to see how that one comes out, but I would expect a strong report there. All right, let's move on to the three you must see. And I'm going to start off with Beyond Meat. I got 3 breakouts for you. I'm going to go through these very quickly. Beyond Meat breaking out above this gap resistance and prior highs, I think looks like it's poised to move higher. OPK also moving higher, taking out all of these tops just below 5. We closed at 502. Look at that volume picking up. And the last one, NYT. This is New York Times breaking out above this double top. Look at the volume pickup. Another one looks good on the breakout. That's it for me today. Wish everybody a great day on Tuesday trading. And I'll be back Wednesday at Earnings Beats for your next Trading Places Live. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.